Joining us now is Max Wolff, managing partner at Multivariate. Max, always great to have you on Cheddar. Look, give us your predictions for the week and also how you think the market is reading into it.
Yeah. So I think this market went from being a little bit tipsy to full-on drunk and driving with one eye closed, and I don't know if that always works well.
Oh
but I think
gosh.
it feels fun for some of the folks.
I don't think it ever works well, Max.
Yeah, well, it's certainly not a tip, right? That's for entertainment purposes only, and it's not part of the informal Wolff
Okay,
driving
good.
school.
A very good disclaimer. Thank you.
I thought that's when the authorities were supposed to step in, that there would be some oversight.
If the authorities are chanting everybody on for the funneling right before the drive home, then I think you got a bit of a problem, right? And they're forcing you not to take the Uber. Look, here I think the market has decided we're going to get fade cut, some kind of faded cut that's now not fading. So you got Grant's interest rate observer, very smart and better at predicting these things than me myself, for sure, by a wide margin, saying they think the cut comes in 48 hours on Wednesday. Either way, this market still wants to be bullish, so bad news is good news, and good news is good news. So the relative coming down in expectations about a deal at the G20 seems to have been more than offset by this notion that we're going to get some rate accommodation. And here I really do want to wave a caution flag, all jokes aside, and all mediocre job analogies, job report analogies from past weeks or this morning's driving one notwithstanding. We're about to cut rates in the next couple of months, would decide that the economy is weak, but we're also being told it's strong by the same people. And either way, we need to have some dry powder because we're running $1 trillion budget deficit and still have low interest rates, and we probably are honestly heading into a recession.
Look, Max, for consumers, I think this is the concern, right? If the trade war ramps up, that's going to hurt the average middle-class American on their grocery purchases, on their clothing and footwear purchases, among other things. But if rates go down because of this trade war, that's going to impact the super wealthy. So talk to us about this imbalance and how it could create this precarious environment for Americans.
So it's a perfect and good question. Unfortunately, I'm not going to have an answer that's as good as your question, but still might be interesting to listen to for the viewers. Look, here's the part of the reason we have such a big risk environment, and the market's bad at pricing that, is because a lot of the risk is political risk, and political risk is hard to price. Nothing drives political risk more than the inequality, right? That's obviously part of the backstory of what we're seeing on the streets of Hong Kong as well. And if we do again have a sharp recession that hits the majority of people with a fast rescue line to a spa lounge for the wealthy, then today's inequality and political tumult will be less than tomorrow's. At some point, you reach a breaking point. So I'd rather not find the mine by stepping on it. And I do think the problem we're going to have is rich or poor. We've kept the sort of drip of assistance on for the whole 8 years. So not clear how much is left in that particular play, which runs the risk that we go into the first recession we've been in since 1934 without a lot of great monetary or fiscal policy interventions to help us.
So what is that? And look, this is the $1 trillion question, Max. What is the timing of this recession that you're warning of?
Yeah, so I think we're probably right on the edge of being in a recession. I don't think we get out of 2019 without one. I think everything under the sun and 5 things that are not supposed to be done will probably be done, because if there is a recession, the electoral prospects of the incumbent president drop to single digits, probably. If there isn't, he's got a very good shot of being the president for another 4 years. So I think we're going to see a guy who threw all the gas on the fire when times were good, throw the gas and the can and siphon your gas and spit it on the fire. So it's going to be a foot race between crazy, reckless, long-term policies that are good in the short term versus the certainty of an inevitable reset to the growth.
So does this recession, does it look like the Great Recession of a decade ago, or does it look like a relatively small blip in a natural economic cycle?
Yeah, so you can't jump in the same river twice, whether you want to or not, so it won't look the same. I don't think housing is the spark point here. I think it could be corporate debt that's in tough shape, and it could be the government. Here's the thing that makes me nervous. The least financially recovered portion of the economy is what bails us out when we have too many drinks at the party, and that's the federal government. The Fed has done everything it could for 10 years now, and we're running $1 trillion deficits. So we'd need structural change, which might be good for the long term, to get out of this one. And that structural change is likely to jive with the political pressure. And that means a little bit of readjustment of affluence down. If we don't do that in the downturn, then we risk that our streets look a little bit less like bull-bear debates and a little bit more like the streets of Hong Kong.
You know, Max, the economy always important, but ever more important with this 2020 election is staring all of us Americans right in the face. Trump's going to make the argument that he needs to be reelected to keep this economy going. We've seen some of the data fall off of late. Obviously, the stock market has been volatile. You know, as an investor, how do you look at this 2020 race, look at the candidates, and how each one of them might affect the economy?
Sure. So it's hard to know what anyone's going to be like as president. And now I'm going to say something that will probably offend everyone, Democrats, Republicans, and independents. The president, when it comes to the economy, is largely a hood ornament unless you have a rubber stamp Congress. So Americans have a tendency to sort of think the president makes all these decisions, and presidents tend to get either celebrated or castigated based on the macroeconomy, of which they have influence, but it's mostly through who they appoint and how much involvement they attempt to take. So, for instance, Trump has presided over a good economic period, which has more or less been exactly the Obama economy with extra stimulus, right? So it's the Obama fitness trainer with a little bit more steroids and possibly a spray tan, but it's not really that different of a person, right? A shower would take it away. So we have seen this for a long time, and he deserves some credit for some business-friendly stuff, but he'll be screaming it's not his fault. He's actually already been screaming it's the Fed's fault. My guess here is that if the average American feels worse off, you lose, whether you're Donald Trump or anybody else, right? And so I think he knows that, and especially for a guy whose foreign policy successes mostly have to do with unsuccessful dinner parties with North Korea, he's going to need that economy to get up over some of the relatively less coy, subtle, and slick moves he's made in the public space, gaffes, Twitter, et cetera.
So what's it like to be Jay Powell right now? Max, take us into the head of Fed Chair Jerome Powell, because this is a guy who's spent the better part of the entire last year getting railed on against by President Trump, the president who actually picked him for that position. He's also maintained the Fed's independence, at least vocally, and when asked about it. But now he's in a situation where it looks like he may have to lower interest rates, and then it looks like to some that he could be lowering interest rates in response to pressure from the president. It's kind of a no-win situation, right?
Yeah, so look, the Federal Reserve has two mandates. Those are its actual job, not the spirit of the moment on any news channel, however wonderful that news channel might be, or any president, however wonderful that president might be, or anyone else. Full employment, so try to keep the economy as strong as possible to keep people employed, and price stability. We have no noticeable inflation whatsoever, and our employment situation is abnormally good, even if that may have a lot to do with some statistical wrinkles. There is no pressure intrinsic to the office of the Fed to change rates, and the validity of the Fed is to be independent. Since December 4th, that's been more questionable than at any point in 30 years. He probably needs to do what's least popular, and the joke about being the Federal Reserve chairman is it's only easy when you're being stimulative, and he came into an overstimulated market. That means you've been handed a flaming bag of poop in Fed world, right? Because it means your job is to take away all the alcohol at the party just when it really gets moving. If he doesn't do that, then he'll be judged harshly by history, even if he's liked for the moment. And we've reached that moment in our economic policy making, and it's hard for me to be confident that we have everybody with big boy pants who's thinking long term in all the right seats.
Max Wolff, our guest with the best metaphors, also managing partner at Multivariate. Thank you so much for joining us on Cheddar Business today. It's always great to have you.
My pleasure. Thank you.